Over the past year, one question has quietly taken over financial headlines, market conversations, and everyday discussions across the United States and beyond. It's a question that sounds simple on the surface but carries enormous weight underneath. When will the Federal Reserve finally cut interest rates? For many people, the logic feels obvious. Inflation is no longer exploding the way it was before. Gas prices aren't surging every week. Store shelves are full. The economy didn't collapse. Jobs are still there. Companies are still operating. So why are interest rates still this high? Why does borrowing still feel expensive? Why are mortgages still out of reach for so many? Why does it feel like relief keeps getting delayed? The short answer is that the inflation problem is not truly over, but the real answer is far more complex, and understanding it changes how you see the entire U.S. economy right now. Inflation doesn't disappear just because prices stop rising rapidly. That's one of the most misunderstood parts of economics. Inflation becomes most dangerous when it slows down but refuses to go away. When it settles in quietly, when it becomes sticky. Sticky inflation doesn't scream, it whispers. Prices don't surge dramatically, but they also don't come back down. They hover, rent stays high. Services remain expensive. Wages push upward. And the economy slowly adapts to higher price levels. That's exactly what the Federal Reserve is afraid of. From the Fed's perspective, cutting rates too early would be like loosening a tourniquet before the bleeding has fully stopped. It may feel good at first, but it risks reopening the wound. When interest rates are lowered, borrowing increases. Credit becomes cheaper. Consumers spend more. Businesses expand more aggressively. Demand rises. And when demand rises faster than supply, inflation follows. The Fed's nightmare scenario is not a recession. It's a second wave of inflation. Because history shows that once inflation resurges after a premature rate cut, the solution becomes much more painful. Rates have to go even higher later. Economic damage becomes deeper, and trust in monetary policy erodes. That's why the Fed has been repeating the same message over and over again. They want to be confident. Not hopeful, not optimistic. Confident. They want to see inflation return to levels they consider stable and sustainable, and they want to see it stay there. Not for one report, not for 2 months, but consistently. This is where many people get confused. If rates are so high, why does the economy still seem to be holding together? Why hasn't everything broken already? The answer lies in timing. Interest rates do not hit the economy instantly. They work with long and unpredictable delays. Think of them like pressure slowly building behind a wall. At first, nothing seems to change, then cracks begin to form. And eventually, something gives. Conditions. Consumers also entered this period with excess savings from stimulus programs and years of cheap credit. So what you're seeing today isn't pure strength. It's momentum from the past. The Fed understands this. They know the full effect of higher rates hasn't fully worked its way through the system yet, and cutting too early could freeze that process halfway, allowing inflationary pressure to survive. This is why patience has become the Fed's dominant strategy. Another major reason interest rate cuts keep getting delayed is the labor market. Despite higher borrowing costs, employment in the United States has remained relatively strong, and as long as the labor market stays tight, inflation risks remain alive. This is because inflation isn't just about prices in stores, it's also about wages. When companies struggle to find workers, they raise wages to compete. Higher wages are good for workers, but they also increase costs for businesses. And when businesses face higher costs, they often raise prices to maintain margins. This creates a loop. Higher wages lead to higher prices. Higher prices lead to inflation staying elevated. Inflation staying elevated forces the Fed to stay of news. Everyone is looking for confirmation that rate cuts are finally approaching. So far, that confirmation hasn't arrived. Instead, the data keeps pointing to an economy that is slowing, but not slowing fast enough. Inflation that is cooling, but not cooling completely. Growth that is moderating, but not collapsing. That gray zone is the hardest place for policymakers to operate. Looking ahead, the next few months will be critical. Not because the Fed is guaranteed to act, but because the margin for error is shrinking. If inflation continues to drift downward and wage pressures ease, rate cuts become possible. But if prices stabilize at higher levels, or if consumer demand reaccelerates, the Fed may be forced to stay restrictive even longer. This uncertainty is why long-term planning feels difficult right now, Businesses hesitate to invest aggressively. Consumers delay major purchases, markets struggle to find direction, and yet this period is not accidental. It's the result of deliberate restraint. The Federal Reserve is trying to engineer a rare outcome, reducing inflation without triggering a deep recession. That has historically been very difficult to achieve. Every previous inflation cycle ended with significant economic pain. This time, the Fed is attempting something different, slowing demand gradually, applying pressure slowly, allowing the economy to cool without cracking. Whether that succeeds remains uncertain. What is clear is that interest rates won't come down simply because people want them to. They will come down only when the Fed is convinced the inflation threat has been neutralized. Until then, patience remains the strategy. This is why rate cuts keep getting delayed. Not because the Fed is disconnected from reality, not because it doesn't care about households, but because it believes the cost of acting too soon is greater than the cost of waiting. The stakes are high, the balance is fragile, and the path forward is narrow. Understanding this doesn't make the situation easier, but it does make it clearer. The Federal Reserve isn't trying to win headlines, it's trying to avoid repeating history, and that's why interest rates are still high, restrictive. Breaking that loop without causing major damage is extremely difficult. The Federal Reserve wants to see a gradual cooling in the labor market. Not mass layoffs, not a collapse, but less pressure. Fewer bidding wars for workers. Slower wage growth that aligns with productivity. Until that happens, cutting rates becomes risky. There's also a psychological component here that doesn't get talked about enough. Inflation expectations matter. If businesses and consumers start believing inflation will return, they act differently. Businesses raise prices preemptively. Workers demand higher wages. Consumers rush purchases before prices go up. Inflation becomes self-fulfilling. The Fed is trying to anchor expectations. They want people to believe that inflation will stay under control, and credibility is everything. One premature rate cut could undermine years of effort. That's why Fed officials are careful with their language. Every speech, every press conference, every sentence is designed to avoid signaling victory too soon. There's also an unavoidable political backdrop to all of this. The Federal Reserve is independent, but it doesn't operate in a vacuum. Every decision is scrutinized by politicians, markets, media, and the public. Cut rates too early, and the Fed risks being blamed for reigniting inflation. Hold rates too long, and it gets blamed for slowing growth and hurting households. Right now, the Fed appears willing to tolerate criticism for being cautious rather than risk being blamed later for being reckless. For everyday people, this means the pain isn't over yet. Credit cards remain expensive. Auto loans stay costly. Mortgage affordability remains strained. Small businesses face tighter financing conditions, and that pressure adds up. At the same time, markets remain highly sensitive.